All right. Hello, everyone. We're going to go ahead and wait a few more minutes. We want to give all the participants enough time to find their seats. See, we got to continue the metaphor here. We got a pretty packed house, so if you have an empty seat next to you, maybe you want to move towards the middle. Let some of the others come in from the side. Look at that. All right, I hope everybody's doing well wherever you are. We're about to 1:39 in, so doors have opened. Right, everyone keep coming in. I'll wait about another minute or so, and then we'll get started. Want to make sure we have enough time for a very important discussion today. This is probably something that's on everyone's mind and very perplexing. And all right, we still going up. Okay, it's now. Okay, I have 5:02, so let's go ahead and get started. We have a little bit of an intro here, so people will still come in as we go on. All right, let's get started. Welcome, everyone. I'm Mickey Quiñones, Dean of the Robbins School at the University of Richmond. I want to thank all of you for joining us for the Financial Markets panel, sponsored by the Robbins School of Business and the UR Alumni Association. Thank you, Alumni Association, for helping set this up. A few housekeeping notes for everyone before we jump in. I know this is a little bit different format than we're used to, but just think of this webinar as a virtual lecture hall. And as I said before, if you have room next to you, if you all want to move in towards the middle, we have some folks still moving in. So let me introduce our panel. All of our panels are Robbins School alumni. I'm very excited about that. And they're all members of the school's Executive Advisory Council, which is a group of highly committed and influential business leaders from around the world who advise the Robbins School and advocate on our behalf. As Dean of the school, I'm very grateful for their insights and their counsel. So thank you all very much for that. All right, first we have Katie Stockton. Katie is the founder and managing partner of Fairlead Strategies. Prior to forming Fairlead Strategies, which apparently is a nautical term, as we learned before we came online. Katie served as chief technical strategist for New York City-based broker-dealer BTIG for 4 years and was chief market technician at Stamford, Connecticut-based MPM Partners for 9 years. She also worked for technical strategy teams at Morgan Stanley and with Soundview. Katie received her Chartered Market Technician or CMT designation in 2001 and later served as vice president of the CMT Association from 2012 to 2016. And in 2017 and 19, she was honored to be the technical analyst for her work. You see a trend here. She is our technical analyst for today. So thank you. She's a member of the Endowment Investment Committee for Christchurch and Greenwich. Frequently shares her views on CNBC, Bloomberg TV, and she often speaks at industry events and conferences. And she's now being a commenter for us. We then have Kathleen Hughes. Kathleen is Global Head of Liquidity Solutions and Client Business at Goldman Sachs Asset Management. She serves as co-sponsor of the Consumer and Investment Management Division Women's Network in the Europe, Middle East, and Africa, co-sponsor of the EMEA, the Europe, Middle East, and Africa Veterans Network, and is a member of the Sustainable Finance Steering Group. She joined Goldman Sachs as a managing director in 2010 and was named partner in 2016. She was named Investment Woman of the Year in the Large Firm Division by Investment Week in 2018 and 19, and is one of the 100 most influential people in finance by Treasury and Risk Magazine in 2011. She's also a member of the Board of Trustees here at the University of Richmond, so she is essentially my boss. So welcome, Kathleen. Michael Kelter is a managing director at First Manhattan Company, a 54-year-old asset management firm with 15 billion of assets under management, and that's billion with a B. He works closely with Sandy Gutzman, the firm's founder and longstanding member of Berkshire Hathaway's board of directors. Prior to joining First Manhattan, Michael spent 6 years at Goldman Sachs in its Global Investment Research Division. Previously, Michael spent 5 years in operating roles within the consumer product industry, very relevant to a lot of what we're going to discuss tonight. And Michael holds an MBA from New York University in addition to his degree at the University of Richmond. He serves on the board of directors and is treasurer of the New York Milk Bank, a nonprofit organization. And last but not least, David Lyons. He's the managing director and chief operating officer of Lowe Brokenbraw and Company, and is a member of the firm's executive committee. He's responsible for the firm's operations and assists with institutional advisory services, serving endowments and high net worth individuals and other kinds of investors. Prior to joining Lowe Brokenbraw, he was vice president of institutional marketing at T. Rowe Price Retirement Plan Services. He holds an MBA from Johns Hopkins in addition to his degree from U of R. He's a member of the UR Alumni Association, so again, part of the group that's sponsoring this today. He's the board of directors president, and he's president and member of the board of directors of the Country Club of Virginia. I'm sure you'd like to be out there doing some of that today, David. He's former chair and current member of the VCU Massey Cancer Center Advisory Board, and other affiliations have included MCB Foundation, Southern Benefits Education Network, served as president, and the Virginia Squash Rackets Association. Not sure if the squash courts are open today, but nope. All right, so let's set the stage. I see this as kind of a drama playing out in four parts. We're going to set the stage. We'll talk about the impact on industries and individual companies. We'll talk about the market impact, and then what advice you have for individuals. And we'll obviously have advice throughout. All right, so let's set the stage here. As everyone knows, we're in the middle of a major public health crisis brought on by a tiny strand of RNA that has wreaked havoc on the world. As of this morning, when I last checked, we had over 3.5 million cases of COVID-19 diagnosed globally, about 1.2 million in the US. There's been around 250,000 deaths globally and around 68,000 in the US. So a devastating human toll that some of us or many of us have probably experienced either directly or indirectly. Now, the response to this crisis has been, by various countries, has been to institute some sort of lockdown, shut down their economies and all kinds of activity, commercial activity. In the US, all but about 5 states issued some sort of stay-at-home order, although some of those are beginning to expire, and we'll see what happens with that. And the economic impact of those moves has been swift and devastating. In the first quarter of this year, we've seen a 4.8% reduction in GDP. And a number of people, a number of firms are expecting in Q2 at least a 30% drop, some as high as 50%. And so we'll see where that stands, and maybe we can get the panelists' opinions on that. In terms of jobs, over 30 million jobs have been lost, and people have filed for unemployment in the past 6 weeks. The unemployment rate is expected to surpass, and again, there are estimates on this, but around 15% by some estimates. Consumer spending fell by 7.5% in March, and further drops are expected. And this is not to mention factory orders and output and so on and so forth. So huge economic outcome. So my first question to the group is, anything you read about the current situation, people use the word unprecedented. So let me ask you, are there any precedents? Is there any good historical analog to the current situation? Katie, I think you had a point of view on this, and then we can go around if anybody else has one.
I guess it depends how you look at things, right? For me, as a technical analyst, I'm looking at the markets, specifically the equity market, really as it pertains to price. So just price-based analysis, looking at history, looking for environments in the past that could equate to what we've already seen. And when I do find those, which are, of course, are usually economically driven, these major downdrafts and the recoveries, we can use those as examples for the current environment. So I would say we don't have a perfect analog from a technical perspective, and we certainly don't seem to have one otherwise either. But what we're actually looking at as the closest analog is recently in December 2018, when we saw a very sharp downdraft and then a very sharp recovery as well. So looking at the move as being corrective, something that may not necessarily give way to new all-time highs again for the equity market, but something that is, the first low is actually the final low. So we're not looking for those March lows, which marked the initial reaction to the pandemic. we're not expecting those to be taken out, and it's in part based on that one analog.
Okay. Any other panelists, when you talk to your clients and within your own firms, what are the parallels? What are the analogs that you try to invoke?
Well, they say, you know, history doesn't repeat itself, but it rhymes. And I would suggest that anything that happened in history in the last, call it 100 years, that caused the market to go down by 25 or 50% was pretty scary, and probably in some respects unprecedented, and thus the uncertainty that drove the decline. World War II, the Great Depression, oil embargoes, the S&L crisis, the financial crisis, were all a little bit different. And so they're all, in a sense, unprecedented. What's similar is that, you know, in every one of the prior cases, it was just a matter of time before the economy found its footing and went on to make a higher high than it did before. And so you know, you could debate the length of time that it would take to do that, whether it's a V or a U or a W, and everyone's got a new way of thinking about that. But, you know, I would be very surprised, and of course, no one here could be able to be the one to say, hey, you were wrong. Very surprised if we don't eventually find ourselves at higher highs.
So let's go to who's been hit the hardest. I mean, we all know the airplanes are just sitting idle. We have, you know, almost a 90% drop and huge percentage of drops in that. So that's an obvious industry. What other industries, Katie? I know you do some technical analysis on this. Who's been hit the hardest?
So when I look at that, I'm also looking at prices, so relative strength. When I look at sector work, I'm looking at the sector basically divided by a major index like the S&P 500. And what's been interesting is on the way down, the worst performer on a relative basis was energy. And on the way up, the best performer has been energy. So sometimes these things kind of, I guess, correct themselves when we see the relief rally. Of course, the relief rally in the S&P 500 has been significant, close to 35% off that low. So we're also seeing the same kind of action in cyclicals. You know, transports, of course, have been hit very hard, and that's for obvious reasons. And yet they're actually having come out of it pretty well too. So it's a matter of looking at not only what underperformed on the downside, and of course there are fundamental reasons for that, but you know, are people willing to step back into these sectors? And I'd say broadly, yes, they are. So we're seeing, you know, broad participation in the relief rally. And yet, you know, I'd still say that the leadership to the upside should probably come from technology. And that was one sector that really was not hit very hard at all in relative terms during the downdraft. So it seems to be treated in a way that's as sort of a safe haven, especially on the large cap front, or really solely on the large cap front. The other thing I would highlight would be sort of the coronavirus sensitive subgroups, biotechnology, of course, being one of them. And maybe on the downside or on the flip side, it would be retail as another one that might be affected more of it in a negative way. So certainly we're seeing that in the stock prices. It's definitely impacting the market. You know, biotech stocks, a lot of them are right up by their highs. Certainly the benchmarks are right there, whereas retailers largely are on long-term downtrends and really struggling much more than a dead cat bounce.
Yeah, we saw. Yeah, we'll come to the cat in a minute. So we saw J. Crew file for bankruptcy today, which was sad to me. I love their suits, so that was. Hopefully, they'll still continue to make those. Kathleen or David, any sectors that have been untouched up till now that you think are going to be hit in the longer term?
I think some of it is too soon to tell because we don't know how the economic impact is going to play out. I agree with a lot of what Katie just touched on in terms of who we've seen do well and who's been relatively unscathed. As you look at technology, that has been a bit of the safe haven.
Okay, thank you. Michael, do you have any thoughts on who's responding to this well? In an earlier conversation that we all had, you talked about how CEOs are really struggling with what's the right response to this. So tell me a little bit about that. Who's responding to this well and who isn't, and what's on the CEO's mind?
I think and we talked a bit about this beforehand. I think, first of all, the hardest thing that the CEOs are dealing with is that they're having to make decisions now based upon a set of facts that have yet to unfold. And it's virtually impossible to know whether they're making the right decisions. And in that regard, they are generally taking the most conservative stance that they can, thinking that whatever the life chance of the worst case scenario being, they can't afford to make the mistake, to be the person that, that does create the next J. Crew because you weren't conservative enough. And so they're drawing down revolvers, even if they don't really feel like they need the cash. And they're doing all that they can to make sure that they're around to fight another day as a corporation. They're also trying to do the right thing by society. For the most part, the CEOs are taking into consideration, I feel like now more than ever, other stakeholders besides their shareholders. They are trying to consider their employees' needs. And you could take a cynical view and say that's only because it's in the spotlight and they don't want to make a mistake. And some of that is true. But I think a lot of them do want to make sure they do right by their employees. I think there are companies that are not doing the things that they would do if they were pure capitalists right now. Companies that are not buying back stock because they think it's politically unpalatable, not reducing their headcount, even if they don't have sales or business to conduct. And so I don't know how long that can last, that kind of charity, but they're certainly trying.
Yeah. Kathleen, I know you follow the movement, the recent trend towards ESG-oriented investment, environmental, social, and governance. And that was a pretty big trend as we were moving into this situation. Do you think this is going to accelerate the trend for people to buy stock in companies that treat their employees well, that do good by society? What are your thoughts on that?
Yeah, no, it's a really interesting topic and one we're spending a lot of time speaking to clients about. I think COVID-19 has certainly shined a light on the importance of, and Michael touched on this, workforce, community, and customers, actually to a company's bottom line. So companies' resiliency has always been based on both financial factors as well as non-financial factors, including ESG factors. And historically, these have been really focused around environmental and governance factors, but now we're seeing really social issues much more at the forefront. So I think the pandemic has definitely amplified and accelerated the push of social issues as an economic reality. So the S has really moved from like a values-based question to more of a material business question. So I think, to my point, companies' actions today are going to have long-lasting implications really related to material factors, whether that's employee satisfaction, worker safety, worker productivity, how you treat your customers, how you support your local communities. And I think as investors, we want to understand how companies will approach social considerations, both in their core business model in the long run, not just in this moment. So how are they thinking about this, on a longer term basis, more sustainably?
Great. And I want to encourage the audience, by the way, to use your Q&A chat if you want to chime in with some questions. So thank you. I want to ask you another just follow-up question to that. So where does the issue of resilient supply chains, was that a governance issue from a risk management? Would that fall under the current conceptualization of ESG or not?
Yeah, I mean, supply chain as it relates to, I would say trying to influence in a positive way good business practices, not only within your own firm, but also as you look at your supply chain or your vendors. I mean, there's roles that a company can play in terms of influencing ESG factors, not only in their own company, but in their supply chains as well. So I think the question of supply chain is around risk management, also governance, and just best practices as it relates broadly to ESG. So I think supply chains will certainly be a question that companies will be thinking about going forward, right? Because we've seen some of the vulnerabilities, and I see David wants to chime in as well.
Go ahead, David.
The only thing I was going to maybe add to that a little bit is, there's the consistent supply chain that we marvel at, that just continues to be, the logistics continue to become more and more complex over time as we deliver things in real time and faster. But there's the temporary supply chain, right? I mean, we've seen several companies, to Michael's point, step up. I mean, there was no plan for some of these companies to pivot and start making ventilators out of factories that were making cars before, and or whether it's protective gear. And so those were financial decisions that CEOs or governing boards had to step in and make at a time with no strategic planning behind it. It is, what is the right thing to do for society today, even if in the short run it may hurt our financials, or it may provide a short-term boon to the financials, but it's doing the right thing. And I think that's part of the supply chain impact has been positive, as you've seen some of these companies. Some of them were coerced and some of them did it on their own. But at the end of the day, we're where we are because of some, I think, good that has been done by some of these companies.
Excellent. Thank you. All right. So we set the stage, what the macro environment is. We've seen which industries have been hit, how companies are responding. Let's talk about how governments have responded in central banks. So we see the Fed and the European Central Bank have pretty much, I don't know if they opened a fire hose, if you will. They've just I think are trying to throw everything but the kitchen sink at this. So Kathleen, I know you have a point of view on this. You want to tell us a little bit about what they've done and why they've done it?
Sure. So, I mean, central banks and governments have taken, both monetary, I'd say, and fiscal actions. Some seem familiar to us because they harken back to the global financial crisis. Some have a bit new or a bit nuanced. But I think one of the things that everyone has remarked at is just the speed that they've moved and implemented policies and programs. They're like an alphabet soup of programs. So I'm not going to go into any great detail, but maybe just to paint like a broad brush on kind of what we've seen take place. I think one of the first moves was certainly, any country that had positive interest rates, took interest rates down pretty quickly to zero or the zero bound. And that's kind of step one in crisis playbook that we've seen in the past. Secondly, we saw, kind of QE infinity, or just, as you said, Mickey, throwing the kitchen sink at it, broad-based asset purchases. Again, we've seen this before, but in some cases, they've gone into new places, like buying, debt from fallen angels in the US. We've seen cash injections directly to individuals, businesses, industries that are really hurting, and lending to those parts of the economy. We've seen specific programs put in place to really ensure liquidity and the functioning of the capital markets. And then lastly, we've also seen some of the relaxed capital ratios and other aspects of banking regulation. So I think all of this, when you look at it in totality, seems overwhelming and shock and awe, and I would definitely agree with that. But I think it's really been a move to provide stabilization as opposed to stimulus. If the economy was in a good place, this would be a huge stimulus, but we know that the contractionary nature of the public health crisis and, restrictions on individual movement and everything that we're living with is very, very contractionary. So I think what governments and central banks have tried to do is just to try to stabilize elements of the economy and the functioning of the capital markets. And I think their goals are, number one, to ensure that the capital markets are functioning, keep that stabilization in place where the parts of the economy have been impacted, and then just buy time, right? They really need to see parts of the economy start to reopen, some people start to head back to work, to really understand what is the short run and long run economic impact. So I think this is what they've thought about and the moves that they've taken. And if others have other elements of this to comment on.
Katie, when you do technical analysis, do you take into account these moves by central banks? Or do you
I guess in a different way, though. I have readings for market sentiment, and it's really the sentiment that is trying to judge these factors and how that sentiment manifests in price. So these sentiment gauges incorporate things like junk bond demand and gold prices, just price momentum for the equity indices, new highs, new lows, the volatility indices, things like that. They taken together can give a good takeaway about not necessarily how are people feeling, but what are they doing, right, with whatever they're feeling. Mm-hmm. And it's those sentiment gauges that got so unbelievably oversold in March levels that we rarely ever see in history. We have seen them, but of course, that the initial reaction that we saw was really important because it happened quickly enough to suggest that we're getting a reaction to the oversold condition in market sentiment. Had we not seen that initial upside reaction, that would be cause for concern to suggest that these stimulus actions are not being well received. And I think the upside follow through that we got on back of that reflected another sort of sentiment phenomenon, which we can all call fear of missing out. So keeps it going.
So Michael and David, so to Katie's point, some of what they're doing is also trying to calm people down and give them a sense of security or a sense of, we're going to do whatever it takes to keep the bottom from falling out. Are you seeing that in your clients and people and institutions that you're advising? Are these moves sufficient to calm people down?
Well, I think first of all, what Kathleen, one of the phrases she used, which I agree with, is that it's a stopgap. It's not something that's going to solve our problems. Giving unemployment, doubling unemployment in a sense to what is now $25 an hour to people through the end of July is not something we can afford forever. The PPP loans will support a small business for only a matter of months. And the same is true of many of the other programs. They're really to get us a bridge from here to there, where at least our clients are. I don't even know if there's a way to generalize. For every client we have that's panicking, we have other clients who are looking at the pullback or the prior pullback as an opportunity to invest. And so it really depends on their psyche, their specific situation. But I'll tell you what some of the conversations I had with people today, which you might find interesting, is it seems like the market initially in early March was at the peak of fear, right? And we weren't sure if this would cause 1 million deaths or 50,000 or something worse or better. It was really the point of maximum uncertainty, and that was when the market dropped. And at this point, it's come back, and a lot of what's come back is realizing that we have a reasonable idea of what the outcome will be as it relates to the virus. I mean, there's still a lot of uncertainty, but we have some narrowing of the potential outcomes, and people are not quite as nervous as they were at 6 weeks ago. What people are having a hard time reconciling is where the stock market is versus the economic reality, as opposed to the path of the virus.
Yeah, and I want to get to that in a minute. Yeah, so that is the big dilemma that people are trying to understand.
Yeah, and for what it's worth, if you go back to 2019 earnings, unaffected 2019 earnings, before this existed, the market today is at 17.3 times that prior year's earnings. 2021 almost certainly will be something less. Certain industries, whether they're the cruise lines or the airlines, will be a lot less, but most every industry will be some degree less. And so if corporate earnings, are not where they were in 2019, and nobody knows what they'll be, but let's say it's some discount to that, it means the market today is trading at 18 to 20 times, a future earnings number, which is expensive by historical accounts. Mm-hmm. And then you layer on the idea that we're spending trillions of dollars today as this stopgap. We're going to have to raise taxes, and we're going to have to in the future, and that includes corporate taxes most likely. And the average corporate tax rate is, for modern history was 30, and it's now in the low 20s. And so if you consider a higher tax rate, the market's not trading at 18 to 20 times, it might be 20 to 22 times. And suddenly you're at a very expensive market for what is an uncertain time in the midst of a likely recession. And so it's hard to imagine there's much upside here. And so I would argue that the risks are to the downside, and those rational conversations are the ones we're having with people now, as opposed to the pure fear.
Okay. So it had the intended effect, or at least calming some people down. You know, you mentioned the long-term effects or maybe medium-term effects. You talked about taxes. People are concerned about inflation, moral hazard. You know, is the Fed going to then start buying equities directly? So nationalization. I mean, what are the concerns for unintended consequences, either in the short, medium, or long term? I don't know if whoever wants to take that one.
All of the above.
Okay. All right. Well, so I mean, I think the issue was people were concerned that we're going to have an inflationary spike in the previous stimulus, but we had a deleveraging that happened. So some people argue that that was what kept inflation from going up. But anyway, so in this environment where we're now seeing these effects from the virus and then the restrictions on movement and restrictions on consumer behavior, one of the concerns is, and one of the questions that we have from the audience is, what has been or what will be the short term and then long term effects on individuals' behavior? So some states are opening up a little bit. So the question is, will people go back to restaurants? Will people go back to airplanes? How long will it be until they do that, if they do that at all? You know, will they go back into offices? So what does this mean for commercial real estate, and so on and so forth? So talk to me a little bit about that. What behaviors do you see changing? What behaviors do you see not changing? Michael, I know you have a point of view on this. So why don't you start with you, and then we'll go on to some of the others.
Well, it's a complex question. Certain things seem obvious, and some of them are just big guesses. And the acceleration of technology seems like an obvious, easy answer to say that we've all gotten used to things like this on Zoom. To say that, broadband internet access is more important, that now suddenly we're comfortable buying groceries on Amazon or some other online platform. There are a lot of technological advances that probably would have taken society many years that have compressed into a period of months, and I don't think most of them are going back. But as far as the other behaviors, I think we're all guessing. I mean, the airline industry is saying, Boeing was, I believe, I forget if it was Boeing or Airbus, I think it was Boeing, saying that they don't expect plane demand to be back to where it was for at least 3 to 5 years. And so, barring a vaccine that gives people some sense of comfort, there'll be a residual, fear of travel, of social congregation, of all sorts of things that we took for granted before. But I mean, we're guessing. You go back to the very first question you asked. That's the part of this that is unprecedented. Okay,
well, I was hoping y'all would bring your crystal ball with you. Somebody asked whether or not Warren Buffett was right in selling off his airline holdings, so maybe he saw into something. Kathleen, you gave me an interesting, I don't know if you'll be willing to share what's happening from a remote work perspective at Goldman.
Yeah, no, absolutely. So I think at peak, 98% of the firm was working remotely, which is pretty remarkable, nearly 40,000 employees. Prior to that, I think the number of official kind of working remotely arrangements here in the European region was, single digits in terms of percentages. So to flip that quickly in a matter of, weeks to being able to accommodate a remote workforce, I think and I know we're not alone. I know a lot of firms have done the same thing. So I think, to Michael's point, this really accelerated some of the trends that were already sort of underway, but it really proved the concept in terms of being able to work remotely. So I think there will be lessons learned around mobility and where workers need to be located, the reliance on technology, being more comfortable with technology, feeling connected to people even though you're not in the same location. So I think those are lessons that will stick with us as we move through this.
David, any thoughts on what you're seeing from your clients?
Well, maybe not as much from the client side of things, but I do think that both of the points that Michael and Kathleen made are on habits, there's going to be some things that stick around and some things that we just sort of forget about and move on. And I think some of the corporate changes, I think, will probably be a little bit longer lasting, whether that's, office space or, potentially supply chain that we talked about before, maybe less reliance on China and goods coming from there and more manufacturing moving back to the U.S. But, when people feel safe again, I think they'll start to travel, they'll start to gather again, and some of those habits will ultimately return. But I think you'll see things like retail will probably take a little bit of a hit as more and more people have learned to order online as sort of a matter of course and not just once in a while as convenient. So I think some of these things will be with us for a while and others will be more temporary in nature, even if it might be a year or two. Eventually we'll feel safe again and we'll start to get back to some of our habits.
All right, so let's get to the heart of the question that I know a lot of people are asking, and Michael alluded to this earlier, and that is, how can it be when the consumers are not buying, there's no revenue coming in, and yet the stock market has recovered almost 30% from its lows in March? I mean, how can that be? We talk about a dead cat bounce. Maybe Katie, you can tell us if apparently that's a technical term since you're a technical. Tell us a little bit about what that is and why, how can this be? Can you help us understand those that.
Yeah, I mean, the dead cat bounce refers to something that really, sort of a lackluster relief rally, something that's not sustainable. And I think we're actually past that point already, except in those lagging areas that are really more heavily affected by the coronavirus, like retail. So we've seen enough of a relief rally that's, I guess, impressive in percentage terms to reflect something that's unfolding in sentiment. And, right or wrong, there are times at which the markets will, I guess, sort of diverge from what makes sense from a fundamental or macro perspective. It definitely has happened. It doesn't tend to happen over the long term. Those long-term trends that we see in the markets are very much tied to fundamentals and macro economics. However, in the short and intermediate term timeframes, we definitely see some divergences, and that's where the charts really can come in handy. You can kind of isolate these moves and chalk it up to momentum, whether it makes any sense or not. It's just momentum there, so that there's a lot of influences on the market these days, and they're not necessarily people sitting there pressing a buy or sell button. So we have algorithmic trading, things that can exacerbate moves. My sense is what we saw in March, the breakdowns that we saw, the loss of long-term momentum that we saw is not going to let us get out of this very easily. It does suggest that maybe what we could be entering is sort of a wide trading range with very frustrating, but big swings in either direction. So it forces us all to become more short to intermediate term almost in our biases if we're investing, because it's really hard to take a long-term directional stance without that kind of clarity and without a real basis for your decisions. So it forces us to be more short-term in our focus, but it also, I guess, is a testament to how active managers can really stand out from passive managers this year.
Yeah.
I would say it's the way that two things. One is the market is treating what we're dealing with as temporary. Clearly, that it's almost like when a company reports earnings and there's a one-time item, and people just choose to ignore it because it's not reflective of the future. And the market seems to be discounting that this is an artificial temporary condition and will go on to life as normal soon enough. And whether that's right or wrong, only hindsight will tell us. The other thing I'd say is the only way to rationally, in my mind, justify where the market is trading is the fact that interest rates are now, rounding to zero. And when you consider what the normal equity risk premium is, and you move your way out from 0% on treasuries to 2% on muni bonds to 2.5% on investment grade corporate bonds, and you work your way down, and equities are trading at a 4 or 5% free cash yield, that's actually not irrational. And that implies 20 times earnings, which is the number I kind of gave before. Mm-hmm. And so for as long as we have lower interest rates, you could argue that the market may remain elevated, even if that doesn't make sense to people who are living their life day to day and aren't spending their time on the markets.
So are you finding, David, I'm curious, when you have something like that that's paradoxical and people can't put their head around it, doesn't make any sense, are you finding that it's difficult for individual investors and institutions that you advise to feel confident in what they should be doing at this time?
Yes, but hopefully they've, whether it's Michael's firm or Kathleen's firm or Katie's firm, any of our firms, hopefully they've placed the confidence in someone who can help them work through that. I'm the operations guy at our firm, but I do get to spend a lot of time with some really, really smart investment professionals. And the point was made today, which was exactly Michael's point of, if you plug a 0% interest rate into a discounted cash flow model, you can come up with some really, really large multiples on there that are much higher than where we are today. And so that can give a false sense of confidence, or maybe that's the reality for at least a while, and would argue that you'll probably be in this range-bound environment that Katie referenced. The idea is that if anyone tells you they know what's going to happen and they sit down with a client and say, this is where we're going from here, that's probably someone you don't want to be working with. No one really knows where we are. And we're going to be looking at things like earnings, and everyone's sort of taken away their 1 year guidance now, and earnings are sort of going out the window. We're taking a look at where we are on science and how quickly we're going to get the things that we need to get back to work, whether it's vaccines, whether it's therapies, whether it's able to do contact tracing. All these things that are now factors that folks are considering. We have to acknowledge that we don't know all these answers. We know a lot more today than we did 8 weeks ago. The fear factor hopefully has washed out some, and we're just trying to make good long-term decisions. We're not making irrational, reactionary trades or swing the portfolio. Make sure that folks have enough cash to get through. Should we retest lows, or should we go through another tough period? But pretending to know that whether it's going to be the valuations are going to be supported by low interest rates, or whether earnings are going to come through in some industries or sectors better than others, it's tough to tell right now, and you've just got to have that very honest conversation with clients.
What investment theses or themes are gaining the most favor? What are you hearing around the firm and from your clients? What seems to be making the most sense? Because I think people want to be able to wrap some sense around their behavior and their decisions. What kind of story are you finding that is gaining most traction?
I'm happy to comment there, Mickey, on one that we've seen actually prior to COVID-19, the idea or the thesis around investing to take advantage of millennial consumption trends and patterns. And a reminder, millennials are now 20 to 40 years old. And again, this has been in place prior to COVID-19, but the demographics of millennials being the largest cohort with purchasing power globally, and we know that their consumption is different in some ways. So what they value and how they consume, very much online consumption, valuing wellness, valuing experiences over accumulation. They're digital natives, they're very tech enabled, and they're value-based consumers. So they want to relate to the values of the company whose goods they buy. So they'll pay more money to buy from a company, because they believe in that company's mission or values. So they do consume in different ways, and they're a very large cohort. I think when you look at where we are right now, there's been a real paradigm shift because, more than a third of the world's population globally is in lockdown. And, regardless of our age, our daily life has moved from offline to online. So we talked about it, whether it's groceries, whether it's entertainment, whether it's your work, working online and working from home environments. So I think the millennial consumption and lifestyle, shift has happened across a broader population, really fueled by the lockdown that we're experiencing and an accelerated adoption of a lot of these trends. So that's something that's been interesting to talk to clients about.
Okay. Katie, I'm not sure as a technical analyst whether you need a coherent thesis or theme, but I'm curious what are your thoughts on that? Are you seeing anything?
I think people are kind of curious what's working and what will work always, just from a sort of a factor perspective. And it's amazing how some of these trends have just really sort of stayed, I guess, prevalent through what we've already seen. And one we already talked about, the large cap technology outperformance, the fact that these names like the Apples, the Microsofts, the Amazons are being seen as safe haven type stocks. And that doesn't seem to be changing. So that's one thing that folks are kind of sticking with. And that's also in falling with what we've seen as US versus international. So on the equity front, US equities have been seen also as a safe haven. And when we're seeing the market move higher, it seems to be a source of upside leadership as well. So US over international. I'd also extend those comments to growth over value. The growth value trends are still favoring growth, and that's something that we really haven't seen break up despite the volatility. So they're really trying to identify the trends that are still working.
Let me follow up. I'm trying to take a few questions here from the audience. Healthcare. So it's a little paradoxical also that we have a healthcare crisis or a public health crisis. You would think that healthcare stocks would be doing well. The problem is that the elective surgeries, the really revenue drivers, are not happening right now. So what is your take on the healthcare sector?
I can give a technical perspective. I think the relative strength there has actually been quite good for this broader sector. And then, of course, specifically for biotech stocks within, as people hold hopes for them during the coronavirus. So the healthcare sector is interesting because it has a lot of diversity. So if you're talking about pharmaceutical stocks, they tend to have a defensive quality. And I think that's also helped preserve the relative strength behind the space. It does not mean at all that they haven't seen some massive losses in absolute terms, but I'd say generally speaking, they actually look better than average from a technical perspective.
It's interesting. There's a question here about, given the quantitative easing and all these different alphabet soup, as you called it, Kathleen, of things that the governments, do you see a future where governments will implement their own digital currencies into the mix? Anyone have a point of view on that?
I like Bitcoin. It's a good chart.
Well, I would say that the bigger trend, which goes back to your prior question about things that thematically are still working, the digitization of transactions is something that has been going on and is going to continue to go on, and probably at an accelerated pace. So the Visas, the MasterCards, the PayPals, the Squares, the companies that deal, I mean, right now, we're still, a large percentage of our transactions are cash and checks. And that's why Visa and MasterCard, for example, have been growing revenues 10% plus for so long, is just the transactions moving more and more and more towards digital formats. And the interesting thing when you think about what, an example of a trend that accelerated in what we're dealing with as a society today, I can't even remember the last time I used cash now. I mean, I don't. I actually think I took a bunch of cash out of the bank when this all happened 8 weeks ago, and thought, out of fear, I better make sure I have cash now. And it's sitting there unused, and everything I'm doing has been with a card or some other form of digital transaction since. So
well, nobody wants to touch a bill nowadays, right?
Yeah. Or if you go online, I mean, you can't buy anything with cash on Amazon. And so I think, whether it ultimately becomes a Bitcoin-like currency or not, be up to the government to decide. But the idea that we're going to digitization of currency, I don't think is even a question.
Okay. So I see a question here from my neighbor, Susan. What role do dividends play in investing going forward? What is your take on that? Michael, Kathleen, Katie, David, anybody?
Well, the long term, if you go back, dividends have accounted for anywhere between 2 and 6% of total returns. It hasn't been 6% for a really long time. Before this all happened, and even now, it's about 2% of total returns. And if the market, on average, has been about 9.5% a year, and only 2 of it's coming from dividends, the rest is capital appreciation. And so it matters. But interestingly, dividend stocks have underperformed in this downturn. And it may be a reflection of the maturity of those businesses and and that they're not necessarily positioned well for the future, and therefore they're distributing their cash to shareholders as opposed to reinvesting. There are a lot of other possible explanations, but there'll always be there'll always be a portion of returns that comes from dividends, but it's been decreasing over time.
Well, there's a question here from somebody, and this gets to something, David, you have mentioned last time we spoke, in that different investors, depending on where they're positioned in their life and their, cash situation, the question here had to do with somebody who's living on dividend income as their retirement income. Should they count on that? Is that going to drop? So tell me a little bit about what you're seeing from different clients that are differently positioned and how their behavior might vary depending on that.
Yeah, for us, we see all kinds of clients, right? We have some of our clients are high net worth individuals and families. Some of them are endowments and foundations. But at the end of the day, everyone has to sort of have an understanding of what they need out of their portfolio, right? And some endowments and foundations, they have enough steady cash coming through annual giving or operations that they don't need to draw on their endowment or foundation in a great way. Others are stretched, and something like this lockdown, they don't have people visiting their museum. They lose their operations. They lose their revenue stream, and the endowment needs to step in and provide more of a function to keep them alive. Most of them are trying to work down their spending policy from what was 5.5% or 6% down to 4.5%. Well, now you've got the double whammy of the market value being down, their operating costs needing to be higher. They're going to have to invade that corpus on a temporary basis. You have some well-funded universities that have great endowments that are offering students a year of financing their tuition. But that's coming out of the endowment. That's liquidity that's needed that would not have been needed otherwise. So the liquidity needs, I think, oftentimes drive even someone who's got a very long-term horizon. And that's the same thing with a high net worth individual. Some have plenty of assets that are going to be passed down to the next generation or to charity, and they don't live off those assets. It's just there. It is a nest egg, and they don't need to worry about that. And their investment will probably stay the same. Others are living off that, whether it's in retirement, they need the income, they draw from that to provide for their living during retirement. They need to make sure they've got ample liquidity, and that may be a combination of making sure they've got enough yield coming from the portfolio or raising some cash to get them through what could be a volatile 2 years. The idea is that there's not one formula out there or one playbook that works for everybody. You've really just got to listen to, and sometimes there's emotion and fear that factors in there. But if you can move that aside and really focus on what is the need and what can you weather out and structure for the long term, you can do that. But you have to understand what those income needs are in the intermediate and in the long term.
This gets to something Katie talked about earlier. This is really in a day of passive investing, it seems like this is a time where advisory services and real someone that can really understand those kinds of situations might have an opportunity to demonstrate their worth. So this is the opportunity. I know there are a bunch of students watching as well. Any advice to our students in terms of either who are thinking about getting into the financial sector, either they're investors themselves, is this a place where they want to go work, or they're about to go work there? What would you say to our students who are going into this world?
One of the things we talk to, the more junior population about is trying to frame and give some perspective. Many of us have managed through crisis in our careers before. They eventually do end. And it's only in looking back in hindsight can you recognize, as things were starting to get better or end or what have you. So, we'll get through this crisis. I would tell them, if they're junior in their career or just starting out in their career, this won't last forever. So it will eventually end. And we're all living through history right now. And we're going to learn a lot of lessons, and we're going to take those lessons forward and apply them, to the next crisis in the future. But having been in this industry for quite some time, I can attest to the fact that they do end. They don't feel good in the middle, but they will eventually end.
I think as somebody who leads a business school within a world-class liberal arts institution, this is a time in which we really recognize that business does not operate in a vacuum, right? We're seeing issues around science and biology interact with human behavior. We see historical knowledge being really important. We also are recognizing, as people are isolated, the need for human connection and the human spirit and all of that. So I see this really also as a moment for us to really show our value in the blending of all those things. Any other advice for our young students out there? Yeah, David.
Yeah, so Mickey, I'll offer this up to whoever might be listening, because I've offered it to my kids and they don't listen, so maybe someone else will. But this is going to be a tough time for certainly the seniors graduating. For those who have gotten jobs, congratulations. That's really terrific. That's well done. For those who haven't, as Kathleen said, be patient and we'll get through this. The juniors, and sophomores who are trying to enhance their resume and get the experience and internships, or just meant a lot of those aren't available. And so I think at the end of this time, the hiring folks, when you come out of this, whether it's 6 months, a year, 18 months from now, they're going to understand that the resume that they saw of the college student a year ago is not going to look like the resume today, because this summer is going to be different and internships are going to be fewer. And so come up with something that distinguishes you, that shows what you did during this time, right? What did you do instead of having an internship? How did you respond to this? What did you do for good for the community? There are ways that you can present yourself in a very positive light, in the way that you show your resiliency and your responsiveness to this situation, that hopefully students will take advantage of, rather than just saying, well, I couldn't get an internship this summer, and I'm sorry, I don't have a couple more bullet points on my resume.
Yeah. Michael?
I'd also say, if it may not be as easy to get a job right now, but luckily for those interested, this is an industry that, hierarchies typically don't dominate. It's one where the cream rises to the top relatively quickly. And so just get any job, even if it takes you a while, even if it's not in New York, even if it's not at the firm you maybe wanted to. But if you got, your foot in, just in the door, and you have any talent whatsoever, this is not an industry that would go unnoticed. And so you'll find your success. Just, it may require some extra work to that first step to get in there, but once you do, I think your career will unfold just fine.
Yeah. Katie, any words of wisdom for our students?
I mean, I guess it's pretty obvious, but to leverage the tools out there like LinkedIn, I'm sure they're way ahead of me in doing that already, but it doesn't have to be an internship with the bulge bracket, with the JP Morgans of the world. It can be a smaller firm, and also to leverage the alumni network.
Yeah. We have a lot of them probably logged in right now. This would be an opportunity, if you have anything related to an internship or job or even a project, that they certainly should reach out to the alumni office and find a way of making that connection. And I think to your point, David, in addition to distinguishing yourself or differentiating yourself, it's really to go do some good. I think this is also an opportunity for us as a business school and as a university to demonstrate that what we have and what we teach our students has value and can help bring society back to a better place where they're going to be at the end of this. So I'm really optimistic about the value that higher education provides, even though we're going to see some rough waters coming up here in the short term. All right, so we're 5:59, so I think we're going to end exactly on time. I really want to thank Kathleen, Michael, David, and Katie for spending time with us. And I know Kathleen is in London, so I know this is getting probably close to your bedtime now, so I appreciate you staying up for us. Remember to check out the Richmond Alumni and Robbins School of Business Facebook and Instagram page, as well as the Alumni and Business School websites. Further information. Also, I just want to give a shout out to the class of 2020. Commencement was scheduled coming up this next weekend, but we're going to be doing a lot of recognitions and certainly a lot of honoring of what they have accomplished. So a shout out to the class of 2020, and we'll be looking forward to seeing them on campus to recognize their accomplishments in a face-to-face fashion. So I appreciate that, and I appreciate them, and we certainly miss them on campus very much. All right, we hope to see you soon. Stay safe, stay healthy, and go Spiders.
Spiders.
All right,
Thanks,
take
Mickey.
care. Good seeing everyone.
Cheers, Mickey.
Bye-bye.